As someone who wants higher stock prices, I mean, that's really our only ideological commitment here on Mad Money. My greatest fear has nothing to do with earnings or the trade war or even the Federal Reserve. No, what I'm worried about is the deluge of initial public offerings that are flooding the market. I know, I've said this before, and I'll keep saying it. We've seen a bunch of ultra-frothy IPOs lately. You know what? And froth, whether it's in the stock market or in this class, not a good sign. See, the stock market's all about supply and demand. When you flood it with new supply, that puts real pressure on the averages. Every time we get another one of these deals that's engineered to be red hot, money managers need to sell something else to raise cash if they want to participate. Eventually, as the IPO cycle goes on, the deals become less rewarding. Investors start getting burned, and people end up turning against stocks as an asset class. And make no mistake, we've had a tsunami of deals. Nearly half of this year's IPO activity has come in just the first 3 weeks of April. 17 IPOs this week versus 18 in the entirety of the first quarter. We had 8 last week alone. This is nuts, people. This week it feels like we're in the eye of the storm with no deals scheduled, but there might be as many as 6 more coming next week. I don't know if the market can handle all that new supply, especially because, say, after the close tonight, we heard from Intel saying dramatic slowdown in Chinese business. Well, you know they're going to sell a lot of techs, and a lot of the next deals that are coming are techs. So tonight I want to give you an update on the state of the IPO deluge, because there's some very important lessons to learn here. First of all, how are these newly minted stocks performing? We tend to forget about them after the second or third day, don't we? While the average IPO from the class of 2019 is up 20% from its deal price, the median's only up 13%, and roughly a third of them are down versus where they came public. Still, if you can get shares in the actual offering, you've done pretty well for yourself. But those shares are incredibly hard to come by. What if you can't get a piece of the deal? On average, these new IPOs are up just 2% from where they started trading, 2%. Although 42% of these have lost you money. Lost you money if you got in on the first trade. And I've got to tell you, I think that's pretty darn sobering. Right, there's nothing surprising in those numbers. Initial public offerings can be insanely profitable for anyone lucky enough to get an allotment in the offering itself. But buying these same stocks in the aftermarket, it has always been an iffy proposition. And look, the IPO market is indeed starting to get frothy. A week ago, we got 2 huge deals, Pinterest and Zoom Video Communications. At the time, I told you the initial moves in these stocks made me a bit nervous. But since then, they've only continued to rocket higher. Pinterest came public at 19, surged at 24.40 at the close last Thursday. Now it's at 28.80. It's up another 18% after rallying for 4 straight days this week. Zoom debuted at 36, pole vaulted 72% on the first day of trading, 62, and it's continued to run, climbing to 65 today. I bet you those stocks both go down off of what Intel said, even though they're not even related to what Intel's talking about. You know where I stand on these two? I think they're terrific companies, but the stocks are getting ridiculously overvalued versus similar merchandise. And they only get more expensive, of course, as they go higher. What about the best performing IPOs? Do they have anything interesting going for them? Okay, let's work our way down the class of 2019. The best performer here is really intriguing, one that I just didn't focus on enough. It's called Jumia Technologies. Yes, JMIA, which some are calling the Amazon of Africa. Pretty straightforward concept. Jumia operates online stores in 14 African countries, including Ghana, Kenya, Ivory Coast, Morocco, and Egypt. They sell everything from goods and services to online food delivery to plane tickets to classified ads. And they also have a platform where small businesses can sell their own merchandise online. Jumia stock has been a juggernaut, and this is one of the few deals where you could have made a killing in the aftermarket. I wish, again, I'd spotted it myself. Thing came public at $14.50, started trading at $18.95 right out of the gate. And now it's just under 36 bucks, giving IPO investors a phenomenal 147% gain. Even if you couldn't get a piece of the deal, you're still up 89% from where the stock opened. And Jumia only came public 2 weeks ago. I am very intrigued by this story still. When Alibaba came public, calling itself the Amazon of China, it turned out to be a terrific long-term investment. Same goes for Mercado Libre, the Amazon of Latin America. By the way, in full disclosure, I was one of the initial investors in that when I was a hedge fund manager. Of course, that's a long, long time ago. It makes sense to me that Jumia might follow in their footsteps. They're the first mover in Africa, and I think that there's real demand for what they're offering. We're talking about a continent with 400 million internet users, a number that's only going to keep climbing. And Jumia's only tapped into 1% of that. I would say there's a ton of room to grow. Portfolio managers are desperate for high-quality ways to play the amazing growth in Africa. Jumia is the one. However, you know me. I hate to chase a stock that's run so much. I say put it on your shopping list and wait for a pullback. And they do come. Do you think many people thought 3 hours ago there'd be a pullback in tech until what Intel said tonight? Next up, we've got a pair of medical device companies. Shockwave Medical's the second best performing IPO of 2019. It's up 127% from its early March debut. Silk Road Medical's in third place, up 89% since it came public 2 weeks ago. Shockwave's technology uses sound waves to unblock arteries that are filled with plaque. This could be revolutionary. Silk Road has minimally invasive procedures that helps reduce the risk of strokes in patients with carotid artery disease. Again, could be breakthrough. Both of these stocks correctly spiked right out of the gate. But while Silk Road pretty much stalled at these levels, Shockwave's continued to rally. That monster $4 move today. At the end of the day, these are two speculative small-cap medical device companies. I don't know enough about either one of them to recommend them to you, but I'm happy to do more homework. So I'm issuing an open invitation to the CEOs of Shockwave and Silk Road to come on the show and explain the respective mousetraps. Of course, anyone who's used them or knows how to use them, please, at Jim Cramer Twitter, right? Then there's a financial technology company, Up FinTech. It's up 83% since it came public a little over a month ago. Sounds like it was created for the FinTech move, doesn't it? Well, sure enough, this is an online brokerage firm focused on Chinese investors. Stock had a huge run, thanks in large part to the recent rebound in Chinese equity markets. But UP FinTech is an American depository receipt of a company that's already trading in China. Do you know history tells us those tend to be real risky? We saw this over and over again with the Chinese IPOs from the class of 2018. They post these huge early gains, then their stocks tend to get obliterated. So if you got a win in this one, here's what I want you to do tomorrow morning. This sound speaks loud, thousands of words. Got it? Nobody ever got hurt taking a profit. After that, we got a pair of software companies, both of which came public exactly 2 weeks ago. There's Tufin, T-U-F-I-N software, up 73% from its IPO price. It's cybersecurity, you know how hot that is. And then there's PagerDuty, up 65%, which helps companies coordinate the data they're getting from mobile devices and use it to make real-time decisions. Sound concept. Once again, we saw some big first-day gains in these stocks. Once again, these stocks are incredibly expensive, and underlying companies are nowhere near profitable. I love a good enterprise software story. Hey, I created the Cloud Kings list. But it's hard for me to get a read on where these tech IPOs deserve to trade. I can tell you they seem too rich for me. Here's the bottom line. We're being flooded with new IPOs here. But when you look at the best performers from the class of 2019, very few of them seem worth chasing, to me, at these levels. In fact, given the big jumps in stocks like Zoom and Pinterest and those weak numbers and forecasts from Intel tonight, I'm starting to worry that this IPO cycle, especially the tech portion, may be reaching irrational exuberance territory.